This is the most important lesson you have to watch in the entire course. Because what separates professional traders who win consistently from beginner amateur traders who lose is the ability to trade based on clear defined rules. Basically, having a mechanical trading plan. So, in this lesson, we're going to go deep dive into building a mechanical trading plan that is not only profitable, but is actually tailored to your trading style, your trading personality, and basically your trading journey. So, quite frankly, if you are still losing money as a trader, you either don't have a mechanical trading plan or you have one, but you are just not following it consistently. Or the third reason could be you just have a lousy one. So in this lesson, like I said, I'm going to go through how you guys can actually build a profitable one so that you can actually make money consistently. So this is basically how the majority actually trades, right? They are hesitate, to take a good trade setup because you just went through a losing streak. Your confidence is low, you're starting to doubt your trading ability, then you end up skipping a good trade setup only to see it go in your way. When this happens, you start regretting not taking the setup. Oh, I should have entered for this trade. I knew it. I knew this would happen. After it has already played out successfully. Now, when you do this, you are basically what I call a hindsight trader, right? Oh, I should have done this. Oh, I should have entered for this trade. Oh my god, I knew this would happen. But guess what? I was too stupid to not actually enter into the trade. Hindsight trading. And then this actually leads you into rushing into a bad trade. And you start forcing trades even though there's no trading opportunity. Because you feel like trading. Because you just missed a good trade setup. And you start to think to yourself, you know what? Let me just go into the next trade without really like thinking through it. Because I already missed a good trade setup. I don't really want to miss another good trade setup. But then, make no mistakes, that is actually a bad trade setup because it's low quality, it's not based or rather aligned to your plan. And then you don't hold a trade to your take profit because you are afraid to lose your current profits. And then you succumb to emotions when you are trading because once again, you do not have clear defined rules. And as a result, you don't know exactly what you are looking for every single day. Now, this form of trading is called discretionary trading, where you are relying on your subjective judgment or gut feeling and the current market conditions to trade. So basically, you enter trades based on how you feel, right? You enter when you feel like it. You get out of the trade when you feel like, maybe the trade is not going to play out. You trade basically based on how you feel and your intuition. Once again, you will not make money consistently if you are always succumbing to your emotions when you are trading. Because you will always end up missing good trade setups and just wasting your hard-earned money, your precious capital on just bad trade ideas. Now, once again, this is some characteristics for discretionary trading. Basically, you are relying on emotions and your gut feeling. And this actually allows you to take bad and low quality trade setups which really don't work at all. It's really not profitable. It's not going to make you any money whatsoever. And the thing is, it's very difficult for you to backtest and journal your trades when you are trading based on your emotions and you don't have like a clear defined trading approach. Because today you are trading this strategy, tomorrow you are trading this other strategy, and then the next day you are trading based on what you are feeling on that day. Oh, I feel like lucky today. I feel bullish today, so I'm gonna enter for a buy. It's very hard to track your data in this way. And if you can't measure your trading performance, how are you gonna improve your trading performance? How are you gonna refine your edge? It's impossible for you to do so because in the first place, you are just trading randomly with 10,000 different trading strategies. So once again, do not do this. Do not be a discretionary trader. So the solution to this is another form of trading called your mechanical trading. Now, this is how the top 10% of traders are able to make money consistently. This is where you rely on a trading system to decide which trades to take, regardless of the market conditions or your emotions, right? So in this case, you are able to identify high probability setups because once again, you are following or rather you are trading based on mechanical rules that's on paper. So if the market does this, you enter for the trade. If the market does not do this, you don't enter for the trade. You stay out of the market. Once again, a very, very clear rules-based approach. And it's much more easier to actually backtest and journal and track your data in this way, because now you are able to record your trades in a way where, okay, if A happens, I'm going to enter for the trade. If B happens, I'm not going to enter for the trade. Now, when this happens, you are entering and exiting the trade the same way every single time. And this really allows you to find out what are your flaws in your trading strategy so they can improve on it. And this really, like I said, it allows that continuous refinement and improvement where you are able to continuously get better as a trader and as a result make more money. Now, when you go onto the market, or rather when the market opens, there's going to be thousands of decisions that you have to make in order to execute a trade properly. For example, where should you buy or sell? What price point is ideal for entry? Will you enter a limit order or a market order? How do you manage your open position? Where are you trailing your stop loss? How are you taking your partial profits? You see, there's all sorts of questions flooding your mind as you see the candlestick starting to play out. And when this happens, it's gonna be very confusing for you. And this increases the chances of you trading based on your emotion, based on your gut feeling alone. If you have clear defined rules in place for every single decision you have to make when you are trading, it will reduce the chances of you trading based on your emotions. In this way, the trading system decides which trades that you should take, regardless of how you feel or the current market conditions. Once again, just to make this clear, mechanical trading strategy will not completely get rid of your losses, meaning you will still lose money. But now, when you trade mechanically, you will suffer good losses because you are only taking trades that is aligned with your plan, right? And this way, you are able to treat these losses as business expenses because you follow your plan and the trade end up still didn't go in your way, because trading is a probability game and the market is random. It is what it is. Move on to the next trade. Once again, when you are trading mechanically, you accept the fact that trading is a probability game and anything can happen in the markets. Now, this is a path, or rather a very dangerous path, a downward spiral that majority of traders tend to fall into, right? This is somewhat like a trap. Firstly, you trade based on your emotions, based on your gut feeling. So this is your discretionary trading strategy. When this happens, right, like I said, you trade based on emotions, you tend to take stupid trades, right? As the quote says, play stupid games, win stupid prizes. So you end up losing trades. Okay, when you lose trades, guess what? Your confidence drops. You start to doubt yourself. You start to doubt, does trading actually works? Like, can trading actually makes me money? Can I actually get rich from trading? And then this actually causes you to miss trade setups, because when you're doubting yourself, your confidence is low. You're thinking, the chart is showing me this. I should enter for the trade. But guess what? Nah, I'm not going to enter for the trade because I just went through a losing streak and I suck at trading. No, right? Then you end up missing the trade. And guess what? When you miss the trade tends to go in your way and you sit there thinking, holy shit, I should have entered for the trade. Now, when this happens, you become once again a hindsight trader where you are regretting, oh my god, I should have entered for the trade. If only I entered for the trade, I would have made $500. I would have made $10,000. God damn it, I should have. And this causes you, once again, to revenge trade, right? Because when you miss a good trade setup, you tend to want to force trades, even though there's no opportunity. When this happens, you start revenge trading, you start entering into trades even though there's no opportunity whatsoever. You are purely trading based on your emotion. And we all know that is a recipe for disaster. And this causes you to lose trades, lose money. And then if you go back to trading a discretionary trading strategy, which means you're still trading based on your gut feeling and your emotion, this cycle will happen over and over again. The sooner you become aware of this entire cycle, this entire trap, the sooner you can get out of it. And then the sooner you can actually become consistently profitable. So, like I said, this is literally how the majority trade, how the 90%, the bottom 90% operate. Once again, these are the people that is giving their hard-earned money into the market. And you watching this, it's your job to take their hard-earned money. And that is why I want to present you the path to success. Right? So, once again, the path to failure is a discretionary trading strategy where you are trading based on emotions, guesswork, or your gut feeling, intuition, whatsoever. The path to success, we are utilizing a mechanical trading strategy. Because when you have clear defined rules in place that tell you exactly what you need to look out for on the charts, what are the trade setups that you should look out for, what is your entry criteria, how should you exit the trade, all of these decisions are answered based on rules inside your mechanical plan. And when this happens, if, like I said, if this trade setup fulfills all the criteria in our plan, we enter for the trade. If it does not, we stay off the market. As this happens, as time passes, you record your data, and now you have sufficient data in order to back up your edge. Right? When you back up your edge, guess what? This gives you confidence. Competence leads to confidence. When you build up that confidence, or rather when you build up that solid data, like, you are winning this amount of trades, your win rate is 60%, you have cold hard data, numbers that tell you that your trading strategy is actually profitable. Guess what this does to your self-image? It makes you feel confident. It makes you feel like you can actually become profitable. And like I said, these are all raw data that allows you to back up your edge and makes you feel confident. And when this happens, the market tends to go in your way, right? Or rather, luck should be on your side. And then you master the mental game of trading. You are able to figure out how to control your emotions, not really completely control, but rather like how to manage your emotions properly so that you don't let them take control of you, and you start trading in a robotic way. And this actually leads you to consistent results, right? Consistent results where you're actually making money consistently. And this is when you can potentially think about scaling your capital, taking your trading to the next level. And that is when you become a top 1% trader, outlier. Now, once again, this is the fundamental law. Remember, you cannot control what the market is going to do or how much money you are going to make. There is only one thing within your control, and that is yourself. You can control where to enter and exit the trade, how much money to risk on each trade, how you manage your floating positions. And by having a mechanical trading strategy, you will be able to become more consistent with your trading, with your actions, and as a result, get consistent results and make consistent profits. Now, a good trading strategy, in my opinion, is not 100% mechanical or 100% discretionary. Oh, god damn it, so hard to pronounce this thing. A profitable trading strategy is 90% mechanical and 10% discretionary, which means you will still need to rely on your human judgment and emotions sometimes, because the markets are always evolving. And this is why majority of the trading robots or algorithms fail, because the markets will always evolve, and you need to continuously tweak and refine your trading plan to suit the new market conditions, right? So adapt or die. In order to build a mechanical trading plan, you need to have these 4 things in place. Firstly, entry criteria. Secondly, exit rules. Thirdly, trade management. And fourthly, your risk management. When you have all 4 of this is when you are able to get a complete mechanical trading plan that tell you exactly what you should do from the start of the trading day to the end of your trading day. So now let's go through one by one. Firstly, entry criteria. As much as possible, try to stick to your entry rules. That means if the setup checks all the criteria, all the entry criteria, then enter without any hesitation. If not, stay out of the market and look for other trading opportunity. So make sure you enter the same way consistently so that you don't end up missing good trade setups and you actually avoid low quality trade setups. So you need to define these things. How do you map your market structure? Are you using the 4-hour time frame? Are you using the daily time frame to actually map out your market structure, your bullish break of structure, your bearish break of structure, your market shift, whether price is in a pullback phase or the push phase? How are you doing this? What time frames are you going to be entering the trade on? Once again, this depends on what type of trader you are, be it a scalper who's entering on the trade on like the 1 minute time frame or the 5 minute time frame, and then a swing trader could be entering the trade on the 1 hour or the 4 hour time frame. Completely depends on your trading style. And then does the point of interest that you are entering the trade on need to sweep liquidity? Because by now you should understand that we only enter the trade when price is at a point of interest. We don't enter when price is in the middle of nowhere. We enter when price reach either a supply or demand zone. And when that happens, or order block, and when that happens, you need to ask yourself, does this point of interest that price actually reach need to sweep liquidity or not? Is it part of my entry criteria? So if it needs to sweep liquidity, then I will only enter for the trade at a sweep zone. If it doesn't sweep liquidity, then I'm perfectly fine with entering the trade on a supply demand zone or an order block that have no liquidity sweep whatsoever. And where are you actually entering the trade on, right? You need to be very specific when it comes to this. You cannot just do it based on guesswork or based on your feeling, or basically what you're feeling at that point of time, right? You need to think about, okay, are you entering on the edge of the zone, basically when price touches it, or are you entering at the equilibrium, the 50% of the zone, or the extreme end of the zone? And also, what are the confluences are you looking out for? Are you looking out for inducements, your push and pull inducements? Are you looking for liquidity, price to sweep, either the buy side liquidity or the sell side liquidity? Are you waiting for your market shift to happen, that shift of order flow, that shift of structure? What are you looking for? What is your entry trigger? So make sure you write down every single detail and leave no stone unturned to make this strategy as mechanical as possible, so that you know exactly what you are looking out for when you go on to the charts. Next is your exit rules. For your exit rules, you want to define exactly where you will get out if your trade does not go as planned, and also where you will get out if the trade does go in your way. So once again, same thing with entries. You want to exit the same way consistently, so you don't end up cutting your winning trades early and you maintain consistent risks. So there's two types of exits, right? One, if the trade does not go as planned, and one, if the trade go as planned. So your stop loss placement, this is where you think about, okay, you want to be placing your stop loss behind your supply on demand zone, or behind your swing high or low, right? And when that happens, how many pips are you placing it behind the S&D zone, behind that swing high or low? Could it be 2 pips, 3 pips, 5 pips, or 10 pips? How many pips are you actually placing your stop loss distance? And then you need to define how many pips your stop loss should be, right? And once again, the minimum is 2 pips, because you have to take into account the spread from your brokers as well. Next, for your take profit placement, you need to decide whether you want to place your take profit based on a fixed R method, which means if price reaches 1:3R or 1:4R or 1:6R, you get out of the trade, no matter where price is or no matter what price is gonna do, right? You just completely get out and respect your R multiple. Or you are placing your take profit based on technical targets, right? Okay, is quite subjective, right? You're exiting the trade at the next supply or demand zone or the next swing high or low. Define your exit rules, because when you set your exit rules properly, you will not regret when price blows past your take profits, because you know for a fact that you are following your plan. And then if the price does hit your stop loss and end up going in your way, guess what? You will know that next time you need to make your stop loss wider and give it more breathing room. This way, you will be able to continuously tweak and optimize your trading plan while maintaining consistency in execution. Now, for trade management, once again, you want to manage your trades the same way every single time, because when you are consistent in managing your trades, your trading account tend to have like a steady growth, like an uptrend growth, rather than going through constant up, down, up, down, up, down, up, down. So you need to take into account the following thing. What trade management method are you using? The set and forget method, or the trading stop loss, or partial profits? Where are you taking partials? And if you're taking partials, how much volume are you removing from the position? And when will you start trading your stop loss? How many pips behind the swing high or low will you be trading? And what time frames are your stop loss and take profit on? You need to take into account all of these things and think about how do you actually manage your open position properly, so that you don't really leave it up all to your emotions. Oh, I feel like taking partial profits today, so I'm going to do that. Oh, I feel like moving my stop loss today, so I should do that. So no, you are just, once again, relying on your emotions. You need a clear rule-based approach. Risk management. So once again, you want to follow strict risk management rules consistently every single time you take a trade, because this actually determines how long you are able to stay in this game. Because remember, you cannot play if you run out of chips. If you run out of money to trade with, guess what? You can't trade and you can't make money. So capital preservation is really the most important thing ever, which is really, it should be one of your main focus. This part right here could be one of the most important part of this mechanical trading plan. So you need to include these things. How much money are you risking per trade? Is it 1% or 2%? And then your position sizing. So for this, you usually go to your position size calculator after you were able to determine your risk per trade and your stop loss distance. Just go to the calculator and just input everything there, and the calculator will do it for you. And how much money are you risking if you are planning to scale in? Because on the first trade, you could have scaled, or rather on the first trade, you could have entered for 1%. You could have risked 1%. And then if you want to scale in for another trade, the second trade, how much are you risking this time? Is it still 1%? Or is it 0.5%? Or is it 2% even? Right? Think about this. And what's the maximum account exposure you are willing to accept? Right? The maximum amount of drawdown you are willing to accept before you decided that this is it. And the max daily loss before you stop trading for the day. Once again, this is very important because this actually prevents you from over trading and actually lose even more money if you are encountering a losing streak. So always just remember this. When you execute a mechanical trade plan that is clearly defined consistently, you will no longer need to rely on emotion or guesswork whatsoever. All you have to do right now is to follow the rules laid out and actually execute them in real time. If there is a trade setup that fulfills your entry criteria and you actually enter into the trade, guess what? Utilize the exit rules, the risk management and the trade management part to actually think about how to manage that position. If there isn't a trading opportunity whatsoever, you stay out of the market. As simple as that. Once again, if it's difficult for you to stay out of the market, just always remember, capital preservation is key. Your focus is not to make money. Your focus is to protect your capital. And then the second focus then is to make money. But once again, remember, you cannot play if you run out of chips. So only when you have a mechanical strategy, you will be able to identify the flaws and shortcomings of your strategy so that you can continuously tweak and refine it, and as a result, your win rate will increase. So ladies and gents, just always remember, consistent action leads to consistent results. If you are consistent in terms of how you trade, day in, day out, the profits will eventually come. Right? It will eventually come. I know for a fact that it will. The opportunity will present itself, and when it does, you execute it without any hesitation, and you win, you make money, and that's how you do it. That's how you do it, by having clear mechanical rules in your plan.